Hey guys, welcome back to the channel. Today I just want to go over how you can put together a sample portfolio of some of these high yield options yield ETFs. Today I'm just going to use QQQY, TLTW, and KLIP. So Defiance and Yieldmax ETFs are great, but I noticed that most of them are kind of single names, and I wanted to see how you could like do a proper allocation, just create like a sample portfolio where if one part of your portfolio goes down, in theory, another part should go up. So I just wanted to use like some of the popular ones such as Yieldmax, Defiance, and iShares. So I use Clip because it's a Chinese internet-based company ETF and they sell covered calls. TLTW because they use mostly longer dated treasuries and they also do a covered call strategy. And then the triple QY is a relatively new one where they sell cash secured puts on a daily basis. So these are the popular 0 DTE. Now, keep in mind that triple QY is really new. So in fact, they only have, at the time of this recording, only one payment. So I had to sort of just make a basic assumption here and that they could, hopefully they can keep their distribution roughly around like the $1.10 mark. And then also for TLTW, this one has a slightly longer track record, so it has a good range of dividend payments. And right now, if you look at their like the premium to like the net asset value across time, you'll notice that more often than not they trade at a discount. So, and I know that the treasuries have been really getting whacked just because the yields are going up. But I don't expect that to continue for like another year. I mean, of course, anything can happen, but I'm thinking of maybe starting a smaller position at TLTW, and of course, like Clip. I think this could be probably the most controversial one, just because one is based in China, and their internet companies have so far they've been kind of treading water here, but again, you shouldn't look at it at that like everything will stay stagnant at the same time. Maybe next year, like Chinese internet companies could start outperforming in the future. So even though like it might be like kind of like an anchor to your portfolio, in the future it could actually maybe become like an engine, if that makes any sense. Now also, Clip also has a so far has a pretty decent uh, well, at least a longer history of paying out dividends. And as you can see, like the amounts, they kind of go a little bit all over the place. So, and then also the good thing about Triple QY is that you can probably uh, start doing things yourself if you want to start replicating their strategy. And I made another video about this, and you can probably refer to it when you have the time. And of course, if you like these type of videos, could you consider liking and subscribing? I would really appreciate it. And then on the triple QY itself, you also have options on the actual ETF itself. And so far, they're not that liquid, and the spreads aren't like that great. But since unfortunately there's a lot of volatility in the markets due to political situations elsewhere, so potentially the spreads will get tighter, and then as more and more people trade this product or buy this product in their investment accounts, like hopefully spreads will improve and also returns can improve as well. So if you look at these two screenshots, uh, I this is from the brokerage Thinkorswim, and now they're part of Charles Schwab. And this shows like how these, for example, TLTW and the correlation to the triple QY right now is not that great because if you notice it's 0.91, that's not a good thing. That means like if triple QY goes down, that means TLTW is also going down. So that's probably not a good thing, at least for now. And then also on the right hand side, if you notice that clip, it actually has a less of a correlation at 0.32. So this is probably like a better example of why you want to include things that you probably don't want to include in your portfolio, just because you never know how they're um, like how they move relative to like other parts of your portfolio. So as I mentioned before, you never know, even though it looks really bad because it's on a downtrend from 25 to 16.85. You don't know when at some point this will go up to maybe, even if you like somewhere midway, like what if it goes back to around 20? You just never know. So what I did was I went back and based on what the available track record was for these ETFs, like their dividend distributions, and I made like just a sample portfolio just for myself, just to see what it could potentially look like. So, and I used like this average scenario of like the prior dividend payments. So the triple QY, as I mentioned before, only has one dividend payment, so this will stay static at 110. And in the future, I'll probably update this to include future dividend payments just to see what the potential portfolio could look like. So basically, what I did was I took $10,000 as just as a mock portfolio, and I put half of it into triple QY, 30% in TLTW, and then 20% in CLIP, just to see what it could look like. And these are the number of shares that could potentially own if you decide to allocate the $10,000 this way. Of course, this is at the time of the recording, so things will change. And then, of course, you guys will probably, you're probably going to swap out certain things. So instead of triple QY, some of you might prefer JEPI. And then instead of maybe Clip, you might want something else like NVIDIA or something. So that's up to you. But I just wanted to show you what it could potentially look like. And so if you do it on a on this average method, you would receive $445 per month on a $10,000 portfolio, assuming everything like the returns remain roughly the same, and that's good enough for like a almost 4.5% return per month, which is not too bad. Um, and then this is the so-called best scenario, but this is not realistic because you're expecting each of these ETFs to perform at like at a high level every month, and that's probably not that realistic. And then you would receive almost $500 per month. Again, assuming they can maintain like a peak performance type of rate. And that would bring you up to like 5% monthly return, which is probably like around 60% a month. But again, this is not realistic. And then just to show you what a potential worst case scenario is, I took like the worst returns that were available for the history. And again, this is not that realistic either, just because triple QY only has that one dividend payment. But this is what we have to work with for now. And again, this will probably go down. Well, hopefully it won't go down too much. So then if you go by the worst case scenario, you'll only receive $380 per month, which which is about 3.8 per month, which isn't so bad. But it's always good to temper your enthusiasm when you're going through these type of exercises, and especially if you're putting large amounts of money at work and and you're trying to dollar cost average and whatnot. And speaking of which, you could also juice these returns, like if you go use margin or portfolio margin. But if you decide to go this route, and I actually hesitate to mention this because this is what some certain hedge funds do. It, it's a very slippery slope. I would actually, for most people, like recommend not doing it, just because like the margin rate, it's really gonna eat into your monthly returns. For example, uh, you know, at today's rates, some brokerages charge around maybe like 7 to 8%. And let's just say like at the your worst case scenario, you do let's say this drops to 3% a month, right? And then so that's like what, like maybe 36% a year, and then 36 minus seven, that 7 or 8, that brings you down to like 28% per year, which again isn't horrible, but you're putting yourself at risk because like you just don't know if any of these what if the treasury markets what if the yield spike and then your the price per share goes down, or even worse, like something blows up in China or even in triple QY, like what if one of the tech companies blows up? You don't want to be holding the bag, and then on top of that, then you have to pay like interest to your broker, and so for most people, I would probably stay away, but it is available, so I have to mention it. And then each of these ETFs, like for example, triple QY and CLIP, the annual expense ratio is also 1%. So again, then you would have to subtract that out of your investment returns. So, but even let's take away like your your expense ratios, your margin interest rates, blah blah blah. Let's just say like you're on a portfolio return, even if you only get, and I say only facetiously, because 20% return is still pretty darn good, especially if you can maintain it over a decade or more. And that's why I like these ETFs because it takes away a lot of the stress of the day-to-day trading. Um, but you do still need to like keep an eye on the price of each of these ETFs. If you still think that each of these, well, both the ETF and then also the ETF company, just keep an eye on them. Make sure like there's no shady business going on. Um, you can always like put a stop order in just in case. Because like nowadays you just don't know, like you don't know who to trust. So always keep an eye on your wallet and keep an eye on your portfolio. So just to recap everything, I think um, like a sample portfolio of triple QY, TLTW, and CLIP for myself. This is would probably be a good like backbone of my portfolio, and then like once I have like a kind of, let's just say like the absolute worst case scenario, 20% on the entire portfolio is only 20%. That would be good enough for me. And then that would really take a lot of stress off of me. And then if you guys decide to follow this yourself, maybe take some stress off of you as well. But again, it's all up to you. And it might save some money on costs for smaller accounts. And so far, each of these ETF companies, they're pretty transparent. Uh, you can see like their individual holdings if you go on each of their individual websites. And there's also potential for boosted yields opportunities because in the future, if the liquidity on the options on the ETFs themselves, as they improve, that could also be a good way to boost your yields. Of course, I do have to mention the risk and that the expense ratios are a little bit high. I would like to see maybe over time, as they gather more money, maybe they can lower the fees a bit. And then you don't have any control over the individual strike selections that these mutual fund ETFs company do. And then obviously your implied volatility for each of these ETFs could go down. It might not be available at all brokerages. So it's always helpful to have like a mix of brokerages just in case. If one doesn't allow something, then you can go to another brokerage to fill it out. And then obviously yields are, as you can see, like have not been consistent month to month. That's why I think it's good to maybe um, do your own average of the ETFs that you're thinking of getting into. And it could be slightly more work because as one of your portfolio holdings like goes down, then you have to maybe swap it out for something else. But and that's probably the only bad thing that I can see. Each of these companies have been pretty good so far, and they are monthly payouts, so something to maybe think about. And once again, if you can like and subscribe, we'd like to put more of these videos out for you guys. So thank you very much, and have a great day.